We have touched on the topic of inventory in a couple of the previous videos. Today, that is all we are going to talk about. For most people who are running their own company or running a department for their company, you don't need to get too much into the weeds. Today, we're not going to talk about LIFO or FIFO or average cost. If you are interested in those topics, let me know in the comments down below. Now, if you're ready, let's begin. So what is inventory? In the general sense, it is stuff that you buy or make that you intend to sell to your customers. If you run a manufacturing company, you may have inventory that is used as raw materials for making your final product. For today, we will focus on retail inventory. It may include things such as beer, food, hair care products, clothing. What is not included is things like fixed assets, such as desk, equipment that is used in your operations, supplies that get used up, such as paper and ink, and employees, obviously. The basic flow of inventory is such: you purchase inventory, you store it on the shelf, and then you sell it. When you purchase inventory, the inventory balance increases. That shows up on the balance sheet as an asset. When storing inventory, it still just sits there on the balance sheet. Money used to buy the inventory cannot be used for other purposes. And if you have too much inventory, you could make it harder to pay bills because you're waiting for your inventory to sell, to turn into cash. Also, if you have too much inventory, depending on what it is, it may become obsolete, like computers, or it may spoil, like food. If you have too little inventory on hand, you could upset customers and miss out on sales opportunities. You will need to find the right balance. When you sell inventory, the inventory balance decreases, and this is on the balance sheet as an asset. And as the inventory balance decreases, the cost of goods sold increases. This shows up on the income statement and is a negative item right below revenue. Selling inventory and generating revenue go hand in hand. So when you put this revenue together with the cost of goods sold, you end up with gross profit. And that is the goal. More money, more money, more money.
Woo! More money, more money! Ah! It's all very exciting.
We got more money than we could ever dream of!
There are a couple of ways to track it. You can use a perpetual inventory system, or you can use a periodic inventory system. First, the perpetual inventory system. This is a system where each transaction is properly and carefully recorded, and it first shows up on the balance sheet as inventory. Then after it is sold, then it goes to the cost of goods sold. And the main benefit of this is that your records are always up to date. There is a negative. It can be time intensive to keep the records always up to date like this. You need to think about how important it is to you and to your business to always know the count of inventory on hand. If you run the risk of running out of various products, you may want to use a perpetual system. If you deal with items that could be subject to product recalls, you may want to have a thoroughly tight system of tracking each individual item. And this can be labor intensive. So not a lot of small and medium-sized companies will do this. Now let's discuss periodic inventory system. An example is when you just record all your purchases as expenses and true up the inventory balances at month end, year end, or quarter end. The main benefit of doing this is that it is faster to record your transactions. A negative is that you might have less of a handle on how much of any given product you actually have on your shelves. A common issue that I see is that many small companies just post all the inventory purchases to cost of goods sold, a periodic inventory system. This is easier, less accounting work to deal with. If you do this over a long time, though, your balance sheet may not have a realistic value for what you actually have on your balance sheet. Why does this matter? If you are pushing too much inventory to expense and too soon before you actually sell it, you would be artificially reducing your net income and your taxes owed to the government. When you get audited, you will owe back taxes and probably have penalties. If you have an external CPA review or audit your books, they may not accept this practice either and force you to make some sort of change. How can you easily remedy this? Do periodic inventory counts, especially at year end. If you find it helpful, you can do it several times throughout the year, but at a minimum, you need to do it at year end. If you only do it at year end, your monthly reports may look goofy, but your year end numbers will be more accurate. When I say your monthly reports may look goofy, what I mean is this. If you purchased a lot of inventory near the end of the month, but did not sell any of it until the next month, you could see a negative gross profit in that first month and a huge positive gross profit in that second month. That wouldn't make sense. Keep in mind that you can count your shelves often, say weekly, just for the purposes of finding out how much you need to order from your vendors. This does not have to impact your accounting system. It could, but it doesn't have to. Now let me know what inventory questions you have in the comments section down below. Thank you and have a good day. Caleb IBN. This has been Managing Your Business by the Numbers. My name is Randy Helm. Thank you for watching this video. If you liked what you saw, be sure to subscribe to this channel and hit the notification bell so that you do not miss out on any new material. Also, please leave a comment down below if there is a topic you would like me to cover. Until next time, have a good day.